If you followed crypto content in the last year and you did what most other people did, then you got this kind of return. Most people have massively lost last year. And the question is this potentially a buying opportunity? Now, this is Bitcoin's long-term chart with a potential resistance line. This is simply just a curved line. There's nothing mathematical about it. But isn't it interesting how the tops tend to align quite nicely? And this gives us a potential upper ceiling. And it also gives us an idea how bear markets and bull markets tend to mute over time, as in both the upside and the downside tends to be less and less extreme. Now, have a look at this. What we have here at the bottom, that is a chart of the maximum drawdown from the all-time high historically. When this is at 0, of course, we are close to the all-time high. When this is below 0, we've got a certain percent drawdown. Now, at what level do we tend to turn around? Currently, we are close to 45% below the all-time high. And we have seen only once a turnaround slightly below the current level, and that was at 50% below the all-time high. That only happened once, maybe over here as well, but we didn't really hit the all-time high. In general, if we hit the all-time high and then turned around to revisit it again, that only happened in 2021. When was that? Have a look at the Bitcoin chart. At the same time, we moved from 3.5K all the way up to close to 60K, then came back down and then hit the 67K. This secondary rally here, the rally that most people didn't have on their radar, was actually not driven by retail investors. When we look at the on-chain metrics, when we look at how many transactions appeared, when we look at the number of active wallets, etc., this grew up until the 60K mark. After that, the market tended to cool down. This secondary rally here was not an organic rally by many market participants. This was basically Michael Saylor promoting Bitcoin and giving it one more rally. So this was a very unconventional rally, and we can see that afterwards the cool down took over and we actually really entered our bear market. Are we going to see a second kind of relief rally again? I doubt it. I wouldn't know what the kind of narrative would be that could bring us again to such a rally. Most metrics right now tend to trend towards a further cool down. When do we normally turn around in a bear market like this? It could be at a level of around 64% below the all-time high. It could be, and that's what I think is more realistic, at levels around 75, 80 or 85% below the all-time high. So 85% was over here. That was when Bitcoin was still very much volatile after the Mt. Gox and Silk Road collapse. 85% was also after the miner collapse, when we had this parabolic run first from $200 to $20,000. Then we had the subsequent bear market with a drop of roughly 80%. That drop was here. COVID already saw us turning around at 75% below the all-time high. The recent crash after Terra Luna and FTX also saw us turn around at around 75% below the all-time high. So what does this imply right now? When we look at the current price, 75% below the all-time high brings us to a price level. Let me expand this chart because it's quite a bit of a drop. It brings us down to $31,000. And I don't think that enough people have this potentially on their radar, that we could fall down all the way to 30K, maybe a bit above that. Now, is this going to happen? Nobody knows, but I don't think that necessarily the current levels of 60, 70K is really going to be the bottom of this potential bear market. Do you follow the cycle theory for commodities? No, I don't. I don't try to beat too many different markets. And this is probably where I'm quite different to most other people trading actively. Because what most people try to do, most people try to do technical analysis on pretty much any different asset, and they use the same approaches for any different asset, and they try to beat different asset classes at the same time. So they're trying to beat crypto, they're trying to beat stocks, they're trying to beat commodities. I don't try to do that. I try to have exposure to all asset classes, but I do think it's a problem. I do think it is a mistake to try to beat them all, because it's hard to be the top trader in all of those markets. I try to focus on one market, that's the crypto market. This is where I believe I've got most edge. And then for all the other markets, I simply try to get exposure to them. I don't try to trade them too actively. I just have them for diversification, and I don't use them necessarily to time them better than the average, because returns are concentrated, right? There are a few people that make most gains, and the vast majority of people unfortunately underperforms, and so we have to put in a lot of effort to be among the few winners. And so regular technical analysis like rolling returns or like the drop from the all-time high can be used for any asset, but then we also have to use this in conjunction with other data that might be market specific, and then it's better to know that specific knowledge that most people might not have. So that's why I think it is important to not try to time commodities specifically all the time. So what we see here is Bitcoin's long-term performance relative to the US money supply. In other words, how much does Bitcoin outperform the US base expansion, the monetary devaluation of the dollar? And what's interesting here is that in the early days, of course, we do see how through Bitcoin's adoption, Bitcoin tended to outperform the monetary expansion. But recently, that outperformance has slowed down. Now, here's something I want to show you that you've probably never really seen before. At the bottom, we see how much Bitcoin tended to perform versus the last year's price. So if this blue line here is below 1, it means that Bitcoin has lost over the course of the last 12 months. If the blue line is above the white horizontal line, that means that Bitcoin has performed positively, right? That we made some gains. And so sometimes we're in a bull market, sometimes we're in a bear market. Sometimes we make money, sometimes we lose. The first bull markets were much more pronounced, as in the very first bull market, Bitcoin made 80x in return. And then came the bear market, and over the course of the 12 months till the bottom of the bear market, it lost roughly 80%. And then came the recovery, the next bull market. This time it wasn't 80x, but it was only 20x or 25x return. Then came the next bear market, the next bull market, etc. And so there it goes. What's interesting about this chart? What I find interesting about this chart is that first of all, we see the diminishing returns, right? The bull markets get more and more muted over time. But at the same time, we see that the bear markets don't necessarily get that much weaker. So the bear markets are pretty much as bad as they've always been. We always tend to sell off somewhere between 75 and 85%. But the bull markets get worse and worse. And so the risk is the same. The reward gets worse over time. The risk versus reward gets worse over time. So risk adjusted, just in terms of returns, if you don't look at any fundamentals, risk adjusted, Bitcoin gets worse and worse. Now, this is common knowledge. But what's interesting is how this is aligning quite nicely over time. What's not great, and this is what many people don't have on their radar, and this is the big decision point in the future. What's going to happen with Bitcoin long term? What's not nice is that at some point, if this trend continues, there will be a turnaround point. At some point, Bitcoin might not have anymore a bull market where we have positive returns over the course of 12 months. We might still get out of a bear market, but the bull market might be that weak that long term, we might not anymore outperform US monetary base expansion. Now, Bitcoin has been created as a hedge against the devaluation of the dollar. But if the dollar devalues, say, by 20, 30, 40% because the US has to print all of that money, because it has to get out of debt, and at the same time Bitcoin appreciates just to exactly the same degree, and of course we have been protected against the devaluation, but we didn't necessarily gain much more purchasing power. So Bitcoin would just fulfill its purpose, but it wouldn't necessarily give us more purchasing power over time. And this is something that I believe is very important to notice here. It becomes more and more important over time to not just hold Bitcoin, but to actually time the market, to actually buy when the market is very depressed and then take profit earlier and earlier. When is that turnaround? It might already be in August of 2028. So that's just 2.5 years from now. And this is unfortunately something that I believe most people don't really have on the radar. Most people, especially people that are 100% in crypto, that are diehard crypto fans, they believe that Bitcoin will always outperform all other asset classes. But things come in waves, right? Attention moves around, and there's sometimes asset class A that outperforms, sometimes asset class B that outperforms. And at some point, markets are saturated. And at some point, we might not see crypto in general outperform other asset classes that much anymore. The S&P 500 over the course of more than 100 years just kept pace with monetary base expansion. It didn't necessarily outperform long term. Now, this doesn't mean that Bitcoin can't grow long term measured in US dollars, but it might just keep up with monetary debasement. How quick is monetary debasement? The answer is it's roughly 6.8% per annum. So this is how much we get new dollars floating around over time. This is how much debt expands over time. This is how many new dollars devalue and thus push up all asset prices over time, including, of course, Bitcoin. But let's see what happens. Of course, I hope that at some point this long-term trend will turn around. And maybe this is a very bearish way to look at things. And maybe if you have some fantasy, it's maybe some kind of curvature in this line. And at some point, things will flatten out and we never hit the zero line, right? We don't really know. This is playing around with data. This is not really knowing what might really go on. Maybe in the end, this top is a bit higher, this top is a bit lower, and we never really reach zero. Who knows? But it's, I think, noteworthy to have this in mind, right? To see how we clearly have diminishing returns, how those diminishing returns are almost perfectly predictable, and how there is a good chance that over the course of 12 months, we do not see anymore the 10x returns or the 3x returns, etc. Future rallies might be much more muted than they've been in the past, and we might just go in line with monetary expansion. If you think this was interesting, then of course, if you haven't yet, feel free to give this a like. And let's have a look at a few comments. Let's have a look at a few questions. Feel free to ask any questions down below. What's your take on copper and uranium? Again, I don't try to beat precious metals markets so much. I just try to have some exposure to gold and silver that's dependent on the current valuation of the markets. And with valuations, I just look at the prices relative to the monetary base. And yeah, I've done this already in prior videos. Feel free to check that out. I don't want to repeat the precious metals analysis this time around. The S&P 500 will most likely cool off, and that will certainly affect Bitcoin in case it happens. Is this correct? Yes, I do believe that's correct. We see a lot of correlation between traditional finance and crypto. This correlation has actually increased over time. So in other words, the two assets tend to go up and down at the same time. There's very little diversification benefit. So if you hold crypto and if you hold, say, the Nasdaq 100 at the same time, your portfolio will either get crushed or will perform very well. You don't really mitigate risk by owning both at the same time. So in other words, if traditional finance suddenly crashes because valuations are very high, then very likely Bitcoin will get affected, and that of course also affects other cryptocurrencies. So it's true, if we enter a bear market in traditional finance, this will have a bad implication on all assets, but especially on crypto, right? Crypto tends to be a levered bet even on the Nasdaq 100. If the Nasdaq 100 goes down by 20-30%, then Bitcoin can easily go down by 50 or 60%. What's interesting about the recent crash, right, the recent drawdown of roughly 50% from the all-time high, is that actually the Nasdaq 100 barely moved. So this is a crypto-specific crash. There's something going on with crypto that is specific, that's idiosyncratic, mainly selling first to the long-term holders. That's not going on for traditional finance. So that's then always the big question, right? Should we buy crypto because it has sold off much more than we would expect based on correlation to traditional finance? Or alternatively, should we wait for traditional finance to crash? Are we now thinking that traditional finance is overvalued and that it might come down? I personally think that the second is probably true, that traditional finance will rather see another dip, which might push us down further in Bitcoin. But I'm not betting on this specifically, again, because I don't try to time different markets that are not crypto. I try to focus on crypto, I try to time crypto properly, and for all other asset classes, I just have diversification. I just add this to the portfolio. Stocks versus crypto aren't that much. Stocks versus crypto do have a lot of correlation. There's not that much diversification benefit, but a little bit is still there. And so I just try to own it all and then rebalance based on my target allocations. Hope that helps. Are there any coins that you like right now? No, there are no coins that I like right now. There's only coins that I like to short, right? I bet on falling prices of very highly inflating altcoins. Hello Gerhard, thoughts on the Trump tariff being kicked back from the Supreme Court? I try not to trade based on political developments because here's the thing, right? If we want to beat a market, we always need to have some kind of edge, right? We need to have a long-term reason why we should beat the market. There's always two components. There's the luck component. There's some randomness in markets because we don't know what a big whale will do tomorrow. But there's also skill, right? There's long-term trends that we try to anticipate. There's also potential knowledge that we might have, some information edge that we have over other market participants because we're just more informed, because we have a better network, because we've got better analytics, because we've got a better data stream. So there is some kind of portion of our performance that's random. There's another portion of performance that's not random, that's skill. And so you need to have, if you want to long-term outperform, not just based on luck, you need to have some kind of skill edge. And so I'm always wondering, what is actually my skill edge in a market? Where do I have a real reason why the market long-term should reward me and not the competition? And of course, competition has different strength, right? If you look at the competition, say, in the currency market, where there is big hedge funds, big quants, big math PhDs that are trading this market, then competition is very high. It's very hard to beat this. Whereas when we look at the cryptocurrency market, where there's a lot of retail investors that trade random meme coins that don't have any value, the competition is weaker and the market is smaller. The market is very fragmented with all of those different altcoins. So it's potentially easier to beat. That's the idea. If we now look at, say, tariffs, right? When we look at political developments, I have to ask myself, do I think that I have any kind of edge anticipating what the political development will be? Am I that deep into politics? Do I know the politicians? Do I know the lobbyists? Do I know anything that the vast majority of people don't know in order to beat the market? If the answer is no, if I do not have any specific knowledge, any knowledge that most people don't have in a particular market or in a particular way of trading the market, then I don't try to trade it in this way, right? I don't try to trade based on politics if I don't know anybody in politics, and if I don't have any insight that most people don't have, if I don't know any lobbyists. And so I simply ignore those facts. I do acknowledge that political developments do have impact on prices, but if I can't anticipate them better than the average market participant, I just ignore this. So I try to find my edge in a different way. I try to then hedge against this, right? So if I say, maybe I think that asset A will underperform the general market. Let's say I think Tesla is overvalued. I don't believe that they can pull off the humanoid robot story, right? If that's my belief, and by the way, it is my belief, but let's say that's what I want to trade on, and I want to bet on falling prices of Tesla in that case, and I want to not have any exposure or little exposure, as little as possible, to say political developments. I just hedge that bet. So I bet on falling prices of Tesla, and at the same time I bet on rising prices of, say, the Nasdaq 100. Even though I might not be bullish on technology stocks as a whole, I just want to get rid of the macro risk. Right? I don't know what the macro risk, say the political risk, will do. I just want to bet on Tesla doing bad, and so I just play the delta. And so I do this in crypto, right? I go, say, long Bitcoin, and I go short many altcoins. I might also do the same in traditional finance. If I've got a strong opinion in traditional finance that something goes down, I might not just bet on the price going down, I might bet on the price going down plus the benchmark going up, and then we tend to make money. Why do I always talk about betting on falling prices? Why do I so rarely bet on rising prices? Because that's what most people do, right? Most people say, I am very bullish on this particular company, I buy the stock of that company. Or I'm very bullish on this particular crypto project, or I'm very bullish on this particular commodity, and so I'm buying it. The reason why in general I tend to rather do the opposite, I tend to rather pick a few losers than pick a few winners, is because picking the losers as per tendency is much easier. And this is counterintuitive. This is what most people don't really think about. But when you think about the market structure, any market for that matter, it's a winner-take-most market. The winner takes most, and losers, or the majority tend to be losers, the majority tends to underperform the benchmark. So if you look, say, at the Nasdaq 100, right? We list the Nasdaq 100 stocks, right? We list them. And we look at their performance in the last year. Right? We order them by their performance in the last year. And then we look at what did the Nasdaq 100 do as a benchmark overall in the last year. The benchmark overall, if that's our threshold, and we look at the stocks that outperformed that threshold and the stocks that underperformed that threshold, we will have pretty consistently 75% of stocks underperforming the benchmark. So 1/4 of stocks outperforms the benchmark, 3/4 of stocks underperform the benchmark. If you buy just the Nasdaq 100 ETF, you get the typical return, but the typical return is just the average return. Right? It's the average, it's not the median. If you pick an average stock out of the Nasdaq 100, you just randomly pick it, you have a more than 50% chance of underperforming. The chance of underperforming by picking a random stock is 75%. Again, because returns are very much concentrated, right? A few stocks outperform massively, and the vast majority of stocks underperforms a little bit. And that's why it's so dangerous trying to pick individual assets to buy. If we make idiosyncratic bets on something, it's much safer, it's much better to have the odds in our favor to bet on falling prices. Now, what this also means, if you already know that the vast majority of assets underperform the benchmark anyway, what that also means is that we don't necessarily have to take the assets that have a lot of discussion around them, that have a lot of trading around them. So Tesla was one example, but maybe it's better to just take a very boring stock that most people don't have on their radar that just tended to underperform the benchmark long term. And we just take that and we just short that, relatively speaking. Right? The same way as we short altcoins, we don't necessarily short the altcoins that everybody is talking about. We short the altcoins that nobody has on their radar. That's just long-term bleeding, where, say, the team has already completely given up, where there's maybe no development at all anymore, but the market cap is still 1 or 2 billion, and there's tokens getting issued all the time. That's constant selling pressure. We short that. We don't necessarily short the token that everybody talks about at the moment in time, because that, of course, creates a lot of volatility, and volatility, right, a lot of movement in the price up and down. That's potentially an enemy for us, right? What we want is very constant underperformance. So let me show you what I mean. Let's take the regular stock market. All right, so let's take, I don't know, Johnson & Johnson, right? J&J, a very regular consumer good stock. And I don't know how well this performs now. But let's have a look at this relative to the S&P 500 over the long term. And let's get over the very long term here. So we see Johnson & Johnson in the early days was an outperformer because it's one of the few stocks that survived, right? When you look at stocks that already traded, say in 1968, that are still relevant today, of course, pretty much any stock that you will find will outperform. But have a look at, say, over the last, what is this, 18 years. It just underperformed the benchmark by 51%. So does it really make sense, in this case, to buy Johnson & Johnson when over the course of the last 35 years, it just performed exactly the same as the S&P 500? I don't think so, right? Because Johnson & Johnson as an individual stock is more volatile compared to the S&P 500. We take on more risk. So we might as well just buy the S&P 500 as a whole. We might just buy VOO, right? The S&P 500 ETF. So why buy an individual stock with all of this additional risk if you can get the same kind of performance by buying the entire basket? And so if you wanted to short, we could of course short something like Johnson & Johnson. But that's just one example out of many. And so in general, I think about it this way, right? I don't try to find the one winner. I try to rather have the odds in my favor. And in order to have the odds in my favor, I just bet on falling prices if I do specific bets. Usually, this tends to be the best, of course, unless you've got some kind of very strong market edge that goes against the 75% rule. All right, so if you can beat the market that well, that you can pick the top 25% performers versus the 75% that lose. If your edge is that deep, then of course feel free to do it. But if it's not, then be careful picking individual assets to buy, because most of the time it goes wrong, especially if you buy many, many different kinds of assets, if you've got a diversified portfolio. Okay, again, feel free to give this a like if you get some value out of the stream. Hi G, what are your thoughts about AI, and do you believe it will rewrite the structure of global economics in a big way? Mass unemployment, universal basic income, etc. It's very hard to say how politics will change based on economic development, but yeah, I do think that AI mainly is a catalyst to increase productivity of the office worker. Thus, there will be less office workers needed. Probably a similar movement that we had when manufacturing went abroad, right? Manufacturing was very strong in the Western economies, then it went to cheaper economies. Now we just see an automation of the office workers' work. And yeah, we might get people getting unemployed from this, but then also people will always find ways to make money, right? If they're in struggle, if they need to make money, they can get into services, they can become YouTubers, they can do anything. That's not that boring Excel sheet crunching task or that create, read, update, destroy, this CRUD development that programmers often just repeat. There's many more exciting jobs, right? Many office jobs are super boring. If it can be easily automated with AI, that's going to be done. I don't believe in AI becoming much smarter than well-reasoning person. There's still room for the entrepreneur. That's what I mean to say. I don't believe in intelligence that supersedes human intelligence anytime soon. Last week you said you can have a look at silver. Yes, okay, let's do this quickly. Let me show you also my approach, right? So when you go to tradingview.com, you just enter click here, or just enter actually. You're on TradingView, you enter some letters. So in this case, silver. You will get to the symbol search. You enter silver, then / and then something like USM2. Okay, so now you get the silver price relative to the monetary base. Because TradingView has a bit of a problem plotting very small numbers on logarithmic charts, I normally add a multiplier on there, so times 1 with many zeros. And now we get the silver price relative to the monetary base. And that's how I look at many assets, right? Especially on commodities that don't have any regular cash flows. We can see how well do they stack up relative to monetary debasement. So if there was no devaluation of the dollar, how would actually the asset do? And it gives us the nice squeeze of silver in 1980s. It gives us an idea of how high silver can go. It also gives us an idea how high silver went compared to the rally in 2011. We can also then look at the average price, right? How much was silver valued relative to the monetary base in general, and how did it fluctuate around it? Are we currently above or below? And what this average price implies now is that this particular asset that we look at will always perform relative to that asset in the same manner. As in, we now expect, because the dollar depreciates by 6.8% per annum, that silver appreciates by 6.8% per annum, right? This is pretty much what this dotted line here means. That then would mean that silver would keep its value long term. Does it though? That's the big question, right? Because silver also gets mined over time. The silver supply expands as well. The US dollar supply expands over time by 6.8%, but the silver supply expands as well. And probably, because it goes up over the very long term, it doesn't expand by 6.8% per annum, but it still expands by 1 or 2%. And so probably this average price that we see here is even an overestimation of the equilibrium price. Probably long term, this should rather go down slightly. And we do see how those bottoms here, right, how they align to a degree. So maybe that's actually how quickly silver gets mined. And that's maybe the kind of analysis we should really draw, how much more upside or downside there is. Have a look at this, right? Those two tops also somewhat align. And of course, we had this short-term manipulation. We had the silver squeeze. But in general, right, I would not be too optimistic. We just look at silver now and we look at its peaks in the past. It's not necessarily that enticing to get into silver. There's always a way to potentially still ride the current momentum, but then treat it as a momentum trade, right? If then the momentum turns around, sell it quickly. If you're now buying silver in order to hold it over the next 10 years, I don't think it's that wise to do, right? It's historically rather expensive. So that's my quick answer on silver. Hope it's helpful. Shorter bear market this time. I'll talk about this at the end of this video, about the duration of bear markets. Good question. It's interesting not just to look at the magnitude, but also at the duration. Hi Gerhard, so many comment on the tax situation. First of all, maybe a comment on tax situation. The numbers imply rising inflation and potential QE following. This could fire on BTC before they fall again. Do you agree? So yeah, regarding taxes, I don't look at it too much. Everybody that's like really big in the market in general tends to not be affected by taxes because trading happens outside of jurisdictions where taxes have big implications. So many companies just set up offshore companies that do the execution of trades. Regarding inflations and QA, what I tend to do is I try to do trades that are specific to my thesis. So this is maybe something that most people also don't do. Most people look at secondary and tertiary effects and trade based on that. So they think, okay, maybe the monetary base will expand faster, maybe interest rates will come down. Thus, when interest rates come down, there will be credit expansion. Thus, when there is credit expansion, my particular risk on asset might benefit from this more. Thus, I buy Bitcoin now. But I think actually that's a mistake. I think it is much better. I think it's much better to rather do the pure play. So let's say you are of the opinion that interest rates will come down. Maybe you think that economics are actually very poor. We've got our K-shaped economy. We've got concentration of capital in the hands of a few. The vast majority is struggling. And because of that, we will have less and less consumer demand. Because of that, employment will be a problem. Because of that, interest rates will get lowered. Just an example as a potential scenario. If you want to play the interest rate game, if you want to play the interest rates come down, why not just buy long-term government bonds? Why bet on the credit expansion and buy the Nasdaq 100 when instead you can just buy long-term government bonds? Long-term government bonds are the purest play on interest rates coming down. There is, of course, the risk premium, right? How stable will the US dollar be? But in general, right, if you expect that the Federal Reserve will lower interest rates, you want to buy long-term government bonds. And you can do this in a levered way with ETFs. So there is the idea, right? So how do bonds in general get priced? The nice thing about bonds is that we know the future cash flows, right? We know how much will they pay over time. We know the coupon payments. Once a bond is issued, the coupon payments are fixed, at least for the regular bonds, right? Not for the inflation protected bonds, but for the regular bonds, the payments are fixed. We do know the coupon payment. Now, when interest rates come down, that means that the future cash flows of that bond will have to get discounted less. Right? The risk-free rate is coming down. We discount the future cash flows less. Because we discount the bond cash flows that are fixed, because we discount them less, they are valued more. They are worth more to us. We have got a bond that pays, say, 7% every year, fixed, and now the risk-free rate comes down to 0. Suddenly that thing that pays us 7% every year is worth a lot to us. And so we've got an inverse relationship between prices of bonds and interest rates. When interest rates come down, then the bond prices go up. When interest rates come up, bond prices come down, at least compared to what the market anticipates. And so if you think that interest rates will suddenly crash and the market doesn't have this yet on the radar, and then the market indeed adopts to this and interest rates do come down, then your bonds will go up. And you just buy levered ETFs on long duration bonds. You can buy TLT, you can buy TMF. There's several ways to play this game, but that's, I think, the better way to go about this. If you are very bearish on interest rates, if you think interest rates come down, do the direct play, right? Don't necessarily play this over 10 corners. Don't necessarily think credit will expand because interest rates come down, and so I buy Bitcoin because of this. Wait, maybe I don't buy even Bitcoin. Maybe I buy Ethereum because Ethereum is more volatile, or maybe even Solana. It has even more volatility. So let me buy Solana now because I expect interest rates to come down. I think this is a bad idea. I don't think this is the best way to go about things. I think it's much better to do the pure play. And in that case, for interest rates, it's just bonds. Bonds are the best play for interest rates. Let's get to a few more charts before we continue with the comments. So far, thank you so much for the comments. It's very, very much appreciated. It always gives me great ideas what to talk about as well. So thank you very much. Let's have a look at a few more charts we haven't yet discussed. So we've already seen how Bitcoin tends to get less and less returns with every single bull market, and how the future might actually be much worse than what most people anticipate. But I want to share other comparisons. So we have looked at Bitcoin relative to the monetary base. What we see here is Bitcoin relative to the Nasdaq 100. And we've already said how both are risk on assets, how both tend to sell off at the same time, and they tend to rally at the same time based on credit in the system. Thus, we should have a look at when those are two assets that are potentially competing for the same kind of capital in a portfolio, and we have our risk on part of a portfolio. When we then decide to rather buy Bitcoin or rather buy technology stocks, when we have the decision between the two, how is actually the performance relatively speaking? And so that's what this chart is about. This is Bitcoin relative to the Nasdaq 100. And this gives us an interesting picture. Bitcoin did not outperform the Nasdaq 100 since 2021. So over the last 5 years, we had barely any outperformance at all of Bitcoin relative to tech stocks. And you took on much more risk with Bitcoin, right? If you bought Bitcoin at 60K, and that's what this peak here is referring to, and you held it up until today, you actually did worse compared to the Nasdaq 100. You lost 46%. You also got a lot of volatility, right? You got your more than 70% underperformance, relatively speaking, to the Nasdaq 100. So if your plan is not necessarily to just buy and hold, your plan is to actively trade, then it does make sense to still get in and out of Bitcoin. But if you're just dollar cost averaging, if you just hodl all your way through, and you just buy Bitcoin because of its long-term great outperformance, you might want to reconsider. Hodling was great in the early days when there was still a lot of adoption of Bitcoin. Just hodling now isn't as effective anymore as it used to be. It's just as effective as buying technology stocks. And if we now work with the assumption that there's barely any more outperformance, yes, we could make the argument that there's still a little bit of outperformance, but it's close to zero, and it's definitely going down over time massively, right? From one top to the next, we get less and less of outperformance. And so we might even make the argument that in the future we see zero outperformance or negative performance, right? This might, if you make the extreme bearish case, this might even turn into bearish territory. Let me see if I find the curved line. There we go. Right, so maybe when this was a lot of outperformance in the early days and we see less and less outperformance now, maybe this turns negative at some point. And maybe Bitcoin will even long-term underperform tech stocks. I don't know, right? It's another potential way to interpret the data. And if we don't take that stance, if we just say, okay, Bitcoin performs the same as the Nasdaq 100, then still, it would imply that we are maybe in a sideways trading range forever. And sometimes Bitcoin is expensive, sometimes Bitcoin is cheap. And if that's now our thesis, if we just say that Bitcoin won't outperform that much anymore, there is still potential for it to underperform the Nasdaq 100 by an additional 50% from here. And this, interestingly, also aligns pretty much with the data we looked at when we look at Bitcoin relative to the monetary base, right? We see there's maybe a potential bottom of 30 to 40K in Bitcoin. Another 50% drop from here, while the Nasdaq 100 stays somewhat stable, would bring us to the same kind of price level. So the data somewhat aligns. Bitcoin relative to the Nasdaq 100, I think, is an interesting thing to look at. It's something that most people also never compare. But most people are in both, right? They are, say, in Microsoft stock, in Google stock, in Tesla stock, and in Bitcoin at the same time. It's the same kind of investor that gets into Bitcoin and the Nasdaq 100. And because it's the same kind of investor, the assets tend to be correlated. Check this out. This is gold relative to Bitcoin, or rather Bitcoin relative to gold, right? Because some people think that Bitcoin is gold 2.0, that it's the hardest of the monies. And on a fundamental level, that is true, right? It is not expanding as quickly. It's harder even than gold. It's a potential investment that can be self-custodied, that's independent of overreach by the government, right? So we hedge ourselves against that. We can just self-custody our Bitcoin. So to a degree, Bitcoin can be regarded as gold 2.0. The problem, of course, is that Bitcoin doesn't trade like that. Bitcoin trades as a risk-on asset. It trades like the Nasdaq 100. It's not as negatively correlated to stocks. But still, it does make sense to make the comparison every now and then. And interestingly enough, we also see how Bitcoin did not outperform gold since it hit the 60K mark, right? It pretty much performed the exact same way. And if you make the exact same thesis that we already made with the Nasdaq 100, and we say that long-term it might not outperform that much anymore, it might make sense to wait for it to really bottom. It might make sense to only buy it when it's clearly cheap. That might only be close to that support. And that would imply a potential underperformance versus gold of another 36% or so. So yeah, nobody knows if those lines hold. It's all just drawing things on charts, but it does give us certain insights, right? It gives us insights of diminishing returns. It gives insights of comparative returns. It gives insights in terms of opportunity cost. Because really, once you've got a certain net worth that's relatively high compared to your cash flows, then it's all about just where do I allocate my capital. If your net worth is relatively low, right? If you have, say, only 3 or 4 months of your regular income as net worth to invest, then actually what you're considering is always, should I be rather in cash or should I be invested in a particular thing? So most people just think in terms of US dollar valuations, right? I now gained that much money. I can go to dinner with that, or I can do a vacation with that. I can do that kind of consumption. I can buy a car, right? That's the kind of thoughts people have. I made not so much money. Should I realize that and then start consuming it? But that's only relevant when you're only in those few months of net worth. Once you are in the several years of net worth, so I think it starts at around 2 to 3 years, right? You look at your annual income, post-tax income, and you look at how much net worth do you have, and it's above 2 to 3 years. When you're there, that's when the inflation rate, that's when the monetary base change over time matters. Because when you've got 6.8% of devaluation of the US dollar, and you're at 3 years of net worth, having that in pure cash, without any returns, right? Without fixed deposits or anything like this. You have this in pure cash. Let's say it's 7 years, it's 7% times 3 years. That's 21% of your net worth that gets, or of your annual income that gets reduced every year. That's a problem, right? So you've got 3 years, 7%, so that's 21% of an annual income that you're losing when that money is not invested. The 21%, that's more than a month. That's like 1.5 months or so that you're giving away to inflation. 1.5 months per year, you're just working for inflation if your money is not invested when you're at 3 years. And so when you're at 5 years, when you're at 10 years, this matters even more, right? Let's say you've got 10 years of net worth and it's not invested. It's just in plain cash. And you've got 6.8% debasement. Then 68% of your annual income goes away to inflation. Why do I say this? I say this because it just says how much more important over time investing becomes as your net worth goes up. There's of course more opportunity, as you've got more capital, you can make more money with it, but also you're now forced to invest. If you just keep the cash as cash without any interest at all, you're basically just working for the monetary debasement. You're just working for that inflation tax. And that's why looking at US dollar prices becomes less and less relevant. And that's why the game over time becomes more and more about just figuring out what to invest in. Not whether or not we should be invested, whether or not we should be in cash or in investment. It's more about what we should invest in. Thus, it's about opportunity cost. It's about, should we get into A or should we get into B? And that's why I like to look at those relative valuation charts. That's why I like to look at how is gold performing relative to Bitcoin? How is the Nasdaq 100 performing relative to gold? How are those relative things performing? Because that then gives us an idea. Is asset class A or asset class B currently cheap? That's then how we just allocate our different weightings in a portfolio. Right? We want to have all asset classes at all times, but we want to potentially have more of a particular asset class when we believe that asset class to be historically cheap. And we want to have less of the asset class when we believe it to be historically expensive, relative to the other asset classes, not relative to the US dollar. And that's why I'm looking at all of those things. It's all about opportunity cost. It's all about capital rotation. It's all about, is a particular asset at a particular point in time really worth getting into? And yeah, that's why looking at Bitcoin when it doesn't necessarily outperform anymore other assets over the last 5 to 6 years even. When we look at those charts, I simply just want to buy them when they're clearly cheap. Not when they might be cheap, but then they're clearly cheap. And history tends to rhyme, right? When Bitcoin crashed already by 75, 80 or 85% historically from the all-time high. When that's historically what happened to BTC, then why would I now, after a bull market, buy already at 50%? And even if I lose the next recovery, even if I'm not joining that next recovery, that's fine, right? I want to buy the things that are cheap. I want to buy things who have a high expected return. An expected return, I mean this in terms of statistics, right? I mean this in terms of, if I bet today, what do I think is the most likely outcome when I look at the potential returns relative to the probabilities? What's my expected return? So outcome probability times return. And we look at all the potential scenarios. And I don't know where, say we've got a roulette table where the ball will fall. But if the odds are in our favor, and I do think that long-term it makes sense to buy into a thing because it's comparatively cheap, then we might not recover today, we might not recover this week or this month even. But if the odds are in our favor and we play the game long enough because the thing is just so cheap, then over time I do expect that things will work out in our favor, right? Casinos long-term win because casinos have the odds in their favor. They don't know where the blackjack table, what the card of the blackjack table will be. They don't know the outcome of the next game, but they do know that when they play 1,000 games that they will make money. And that's how I think about investments. If I buy something that's historically super cheap and I do this all the time and I do this over the long term, then I do think that outperformance is very likely. That's just how I think about the market. I hope it gives a different perspective to what most people do, right? Most people think about things deterministically. They think about, okay, we haven't yet reached the bottom, so we have to crash down. I'm not even saying that. I'm just saying that Bitcoin is not yet that cheap. And that's why I'm not buying it. I'm buying it once I see it to be very cheap. And that's just measured here now in dollars, but that's also measured versus the NASDAQ. That's also measured versus gold. That's how I fundamentally think about the dynamics of markets. Have a look at the following. This here is the prior bear market. And I want to talk about the duration of a bear market now, right? A question that we had just a minute ago. This is the prior bear market where first Terra Luna imploded, then Three Arrows Capital, then FTX. We had a lot of systemic collapses during that bear market. We did not see any major collapses yet. And this might be a potential reason to look at what could happen, right? Maybe at some point we see history repeating itself to a degree. And if we just take that as a comparison, how long could we be in a bear market for? We might not drop all the way to below 30K, because I do think there might be some kind of a slow decline of those bear markets, right? We could, in theory, if we wanted to, also draw lines like this. It's maybe not as likely of a scenario, right? But this here is, again, the drawdown from the all-time high to the bottom. We could play the argument that maybe the bear markets also get slightly less severe over time. But yeah, it's a bit of a stretch, but we could make that argument because the very first bear market over here also was not as pronounced. So I rather think this is like hovering around a certain level, but maybe the bear markets also get slightly less severe over time. If that's the case, right? If it's not just the bear market, it's not just the bull markets that get worse, it's the bear markets that also have less and less volatility, then maybe this is too bearish. Then maybe a repetition of history is a bit too bearish. If history was to repeat itself, we would turn around below 30K, but I think maybe we won't. Maybe this bear market will be a bit less severe. Right? Maybe it will look something like this. If that's the case, how much longer could it take? We could wait until Q4 of this year. So the entire year of 2026 could still stay very bearish. The duration of bear markets historically tended to be roughly a year, right? So from here, from the top to the bottom, it was 385 days, a bit over a year. When we look at this bear market over here, that was 362 days. When we look at this bear market over here, that was 396 days. So it tends to be roughly a year. A bit more, a bit less, but roughly a year. And so we started the bear market in October of 2025. So there is a good chance that it might take at least until August, maybe October of this year, until we reach the bottom. So we're not even halfway through in terms of time. Will that repeat? Who knows, right? The sample size is very, very small. But I rather tend to go with that, right? If we haven't dropped as much compared to prior bear markets, and if also the duration hasn't been as long, then why buy now? Maybe we just stay at the current level for the entirety until we reach, say, October of this year. Maybe there won't be much more of a sell-off, but we just stay at the level. If we do, it might already make sense to buy at that point, because then, at least in terms of duration, the bear market is over, and it might make sense to take first purchases. But we then have to reevaluate, right? Then the pattern, the historical pattern has changed, and we have to figure out where is the average cost basis at the time, what are the long-term holders doing at the time. We have to look at some more deep metrics, right? We have to look at on-chain data to figure out what's actually going on at that particular point in time. But that's then up for discussion if we even hit that, right? If such a scenario plays out, if the overall long-term trend changes. Let's have a look at a few more questions. Do you think an imminent pump is around the corner of about 40% in Bitcoin, ETH, and Solana? There's always, quote unquote, the risk of a pump because we are currently betting on falling prices, right? If you've been following this channel for a while, you know that I'm not too bullish. I'm betting on falling prices basically since we are below the 125-day simple moving average, right? The line here in turquoise. So we make money during this drop. And there is a risk, quote unquote, of a rally to at least go above the 44-day simple moving average, right? That's this line in orange. That would not mean a 40% rally. It would mean 16%. 40% would bring us even above the 125-day SMA. That would bring us into a potential, at least medium-term recovery. At that point, we also have to look at what's going to happen with, say, what's going to happen with the stablecoin market cap, is that expanding? Is then suddenly money flowing into the space again? If the answer is no, then we might also be cautious with even buying here. But in general, we are currently in a bear market. There is a chance that we go up, say, to 80K, and we'd still be rather bearish. Once we hit the 90K mark, then there is a good chance that the bottom is in and that we rally again. But yeah, I'm not betting on this right now, right? If we follow trends in general, we never sell the perfect top. We never buy the perfect bottom. We just follow according to when a trend has been established. And as per definition, right? If we wait for the trend establishment, we've already seen some kind of a recovery in the bull market, and we've already seen some kind of a crash in the bear market. And so I don't expect to buy the perfect bottom. I don't expect to sell the perfect top when following trends like this. But this strategy in general works, and that's why I use it, right? So this is when I backtest all the different moving averages. This is when we follow the 44-day simple moving average over time versus just buying and holding Bitcoin. And here's the same for the 125-day simple moving average. Since those approaches just worked very well, I just continue using them. What are your thoughts on XRP, possibly decoupling from Bitcoin? I don't have a good reason. Thank you, by the way, for the super chat. I did not notice that that's a super chat. Thank you very much. I don't really see a reason why XRP should decouple. There is the only difference between XRP to all other altcoins is that it was able to keep pace with Bitcoin, at least to a degree, long term. Fortunately, this is not a long-term chart. This is from Coinbase. Let me take the data from crypto in general. This tends to be longer term. And let's also multiply this with a few zeros. Since it's a super chat, I want to look at this individual altcoin now. But yeah, have a look at this, right? So this is XRP relative to BTC. This is one of the very few altcoins that actually have been able to make it over all of those years. There is a lot of volatility every now and then, but it tends to trade in a range with BTC. Most altcoins over such a long period of time, right? Over, let's see, how many years do we have here? This chart starts in 2013. So this is 13 years of data, or 12 and a half years of data. Most altcoins underperform much more than Bitcoin over that time period. XRP, interestingly enough, did not. It did underperform somewhat, so by 66%, but over such a long period of time, that's actually not much for an altcoin. Most altcoins did much worse over that time period. So that speaks for XRP. Do I see a real decoupling? I don't see it, right? I rather see a trading range, and if I want to get into idiosyncratic risk, I rather buy it at the lower ends than at the upper ends. Currently, if you look at the average price, right? Have a look at this. This is the dotted line. That's the average price. We could make the argument that XRP is currently cheap, but we can also make the argument that it tends to trade in relatively consistent trends, and that currently that trend is rather negative, and that there is the risk of XRP to underperform Bitcoin by another 67%. So at this point over here, it might make sense to take a bit of a risk on bet, to take that idiosyncratic risk and buy XRP. At the current level, just based on technical analysis, I don't really see it. And so that's how I always look at any altcoin, right? I always want to know this additional risk that we take, do we actually get it compensated? And very long term for XRP, we didn't, but at least very long term XRP kept pace to a degree with Bitcoin. For most altcoins, when we look at their development in 2013 up until today, they're all forgotten, right? So XRP, this chart starts in August of 2013. Let me actually show you what I mean. So let's go to historical coin market cap. This is an interesting overview, CoinMarketCap's historical data snapshot. And let's go to August of 2013. Let's have a look at the top 100 cryptocurrencies. We've got Bitcoin, we've got Litecoin, we've got XRP. We don't even have Ethereum over here. Have a look at all of those other names, right? Namecoin, Peercoin, Feathercoin, Novacoin. Nobody knows these tokens anymore. Infinite Coin, DevCoin, they're all at zero now, basically, right? This WorldCoin is not the WorldCoin we know today, it's another WorldCoin. So all of those things went to zero, and XRP was the only token that was able to somewhat still stay relevant. Litecoin also underperformed Bitcoin by a ton. So this is where XRP is different, and that's why I respect the question. It does make sense to have a look at it every now and then. But unfortunately, right now, it's not that cheap, right? Right now, unfortunately, do I still find that chart? Here we go. Unfortunately, I don't think now is the best time to get in. It's not the worst time either, right? We are not at historically elevated prices, so you do want to buy when attention is low. And currently attention tends to rather bleed, but we are not at a level where I think it's a must buy. And again, most altcoins tend to underperform Bitcoin most of the time, and over the very long term, this is also true for XRP even. But maybe it can keep pace. But it's not necessarily a better investment than XRP long term. Thank you for the question. Thank you for the super chat. Very much appreciated. By exposure, do you typically utilize ETFs to invest longer term in asset classes other than BTC? Yes, I do like to use ETFs. I do like to own QQQ. I do like to own TLF and TLT and TMF. I do like ETFs because it just gives me benchmark exposure, right? So that's what I in general try to do, right? If I just try to write the market itself, I try to figure out what is in general the most typical kind of return, what's the benchmark, and then I just get that. I don't try to get fancy outside of crypto. Could you take a look at the MVRV ratio score? Yeah, you can have a look at this yourself, right? Just have a look, just Google it, MVRV Z-score. MVRV fundamentally just looks at how much are we currently in profit relative to the average cost basis, relative to the realized price. Realized price is currently at 55K, I believe. And with the MVRV Z-score, what we're doing is we're just looking at how much are we currently in profit and loss relative to the volatility. So if the volatility is high, then we can be okay with more potential unrealized gain. If the volatility is low, then if we have a lot of unrealized gain, we should rather sell because the market is overvalued. So it just looks at how much are we currently in gain or profit relative to how much risk or how much fluctuation there currently is in the market. But I don't think the risk and the fluctuation is that important. I think what's more important is actually, are we currently in gains or in losses? Are we currently above or below? That's already enough. Just looking at the realized price is already enough. Looking maybe at the long-term holder realized price enough. We don't necessarily have to put this into ratio with the volatility. I don't see that much additional benefit doing that. Would you consider introducing a take profit on the strategy to lock in profits when it hits certain deviations? That's probably related to the trend followers. I would only consider that if we have a good rule for that. So I try to follow rule sets. I don't try to do any kind of trading based on just gut feel. I try to always have a thesis of why things should do better long term, right? I bet on falling altcoins because they have token unlocks, because they have insider selling, or because they are very high, relatively speaking, in their trading ranges. And I try to follow trends based on the backtest. And so if I have a backtested way to take profit earlier, a certain rule that says, okay, if we are in profit by that degree, then historically it was a great time to take profit and sell Bitcoin even if we are above the moving average, then I might do so. But I need to have a trading rule for that. And I have not yet backtested a rule that gives me better returns compared to just plain following the moving averages. So that's why I don't take profit. I would never take profit just based on individual circumstances for this trading vault. But if we have better trading rules, if I've got new backtests with new results and they outperform over time, they outperform across many asset classes, then I do it. So I'm always looking at how, if I want to assess how good of a strategy is a certain trading rule set, I look at the outperformance, not just over the overall time, like did we do better than buying and holding? I'm looking at it over different time windows, how consistent is the outperformance, and I'm also looking at it versus other asset classes and versus other assets. Does this trading approach work also, not just for Bitcoin, but also for Ethereum, but also for Solana? If the answer is yes, then trading approach is probably good. Does it not just work in year 1 or 2, but does it work for all of the years? If the answer is yes, then it's probably more solid. So we want to look at how consistent is our outperformance as well, not just do we have outperformance. And if we introduce now a new trading rule to backtests, then we just have to figure out, is that new trading rule as consistent in its outperformance? If the answer is yes, we might introduce that rule and also add some profit taking. 30-something Bitcoin, wow, so optimistic. Well, okay, we are early in the bottom shelf. Yeah, so this is the kind of comments I get all the time, right? That I'm too bearish. And that's actually also the reason why I have this change in my picture. It's actually like a semi-joke. So when we were at 120K, 110K, when we were in October last year, and I was so bearish, and I always said like, sell, sell, sell. I'm betting on falling prices. Sell especially the altcoins. Sell it all, bet on falling prices, hedge yourself. I don't know where it goes, but I only see it's expensive. When I did this, and pretty much every video was bearish, people like, as a joke, called me not Gerhard, but Bearhard. Right? I'm the bear, I'm the perma bear. And then I also bought, you can probably barely see this little bear costume over here. And I wore this. And people just made fun of me. And that's then where I just, embraced it and then changed the picture of the channel as well. Because that's the thing, right? If you trade and you outperform, there are times where you have to be contrarian. The vast majority of people does not outperform. And so if you follow what the vast majority thinks most of the time, you're going to lose. There are, of course, trends where it does make sense to follow when the majority establishes itself. But once there is a saturation point reached, and there aren't that many more marginal buyers, but there are a lot of people in unrealized profit that could become marginal sellers, then it makes sense to sell. And then it makes sense to be contrarian. And it's much harder actually to be contrarian at the cycle top than it is to be contrarian at the cycle bottom. The reason why it's harder is because the sentiment is very different. here's what happens, right? When we are at the bottom of a bear market, usually all the bulls are already gone, right? Everybody that's permanently bullish is already gone. They've already lost their money. They don't even follow crypto content anymore. And so when we are in a bear market, at the bottom of the bear market, and you post a video that's bullish, where you're saying, I think Bitcoin is now a good buy, you're actually going to get, if you also join the YouTube game or the social media game in general, right? You're actually going to get a lot of supporting comments. People will say, yes, I also think now we are in the bottom. I'm buying Bitcoin as well. It feels very good to make those videos. They might be contrarian in the grand scheme of things because most people are not interested in Bitcoin, but the people that still watch, the very few people, the minority that's still interested in Bitcoin, they will still watch, they will still support. So we are then this small little universe of people that all support each other, and it feels great. When we are out of the bear market and we are in the bull market, more and more new people enter the space, and the vast majority of people will enter at the end, right? Because it's compounding, right? There's a few people, right? We start with 10 people, as an example, 10 people buying Bitcoin. The price rises, then it becomes 15 people, it becomes 20 people, it becomes 50, it becomes 100, it becomes 500. And so the vast majority of people, right, because it's growth, the vast majority of people bought for the high prices. And at some point, though, it will not be 500 people. It will then only grow slower. It will grow from 500 to only 600, to only 650, to only 700. So the growth slows down. And the people that bought early, right, the people that bought when you're still watching when prices were low, that are now starting to take profit, right? They take gradual profit along the way, as we appreciate. They're happy, they're realizing profit. But when you then make a video at the top of the bull market and say, I am pessimistic, hedge yourself, rather be careful, people will attack you. And that's why it's so hard for many YouTubers also to make those videos. It's first of all the direct feedback that we get from the comments, but it's also hard because the algorithm does not support that. If I made a bullish video at the top of a bull market and the vast majority of the market is bullish, I will get a lot of praise, I will get a lot of thumbs up, I will get a lot of support by the algorithm, right? There's a longer watch time as well because people want to get their biases confirmed. But if I crush the biases, if I show my data and I say, come on here, this is maybe a bit too high now, let's take some profit, then people don't want to see this. They click away, they give thumbs down, they might even unsubscribe, and I get less exposure by the YouTube algorithm. Still, I make those videos because I know once the bear market is established, all the bulls, they are out, they don't watch anyways anymore, and the few people that have watched the video, that might have taken some profit at least, they will continue watching. And so this is then how a channel like this can grow over the cycles, right? From one cycle to the next, the audience grows because the people simply don't get as much burnt or even make money during a bear market. And so I'm playing the long game, right? I'm playing the game over the cycles. This channel is now roughly 5 years old. So we've already been through the FTX and Terra Luna collapse. Feel free to watch the most viewed video on this channel. That was at the height of the Luna collapse, right? This is when the last bear market started, where many people were actually buying the Luna token, the super highly inflating Luna token, and they got burnt massively. And many people bought the dip and the crash and lost it all. And the people that watched the videos published here, they hopefully got spared from some of the losses, and that's also why a lot of the people watched at the time. But I play the game for the long term, and I'm okay to be contrarian, especially at the top of the bull market when most people aren't, and I make a bit fun of it, and that's why there is the bear heart logo. But yeah, so that's why I'm okay making those predictions of potentially even 30K. But I think it already makes sense to buy at the realized price, right? Once we are at the 50 something K, it starts to make sense to make first purchases, then buy more as we go lower, and we might already bottom out at 40K, maybe even a bit above that. That's my base case, at least. I don't have a crystal ball, but it's my base case. That's if history was to repeat itself to a degree. Thank you for all the comments. Trying to find an interesting question to follow up. I'm in gold and cash right now, waiting. What's your opinion, May, October? Cash is always good. Fixed deposits, I've got a lot of money now in fixed deposits that get unlocked regularly, where I also have some flexibility to buy bottoms in case we see a crash. Gold is expensive, as silver is, as we've already talked about. What do you think of ENA? I don't want to talk too much about individual altcoins on live streams because the vast majority will not enjoy that. Most people are not interested in individual altcoins right now. Neither am I. Have a look at the following. So this is now Ethereum relative to Bitcoin. And what's interesting is that since the merge, so since it moved from proof of work to proof of stake, since all the miners, they exited the Ethereum ecosystem, the system itself tended to grow much slower. And because of that, because we didn't have this new influx of new people, and this I think was one of the reasons why the ecosystem grew so much in the first place, we tended to underperform Bitcoin and the market in general. This here is Ethereum relative to Bitcoin. This marker here, that's the move from proof of work to proof of stake. Many people were very much anticipating that technological change. It also improved the tokenomics of Ethereum. But since then, Ethereum was just getting sold off, mainly by the OGs, mainly by the people that invested in Ethereum very early on. Now, we did have a rally, right? We did have a bounce that started in April of last year, where Ethereum outperformed Bitcoin by almost 150%. And we all know the story around this, right? We all know why we saw that outperformance. That was because of Tom Lee of BitMine buying. So everybody now thought, okay, we will have Ethereum treasury companies, very similar to how we have Bitcoin treasury companies. So more and more public companies, long-term accumulating Ethereum, helping the price. But that only lasted so long. That only lasted until September of 2025. That was because the purchasers outside of Tom Lee's BitMine, they slowed down. So no other company bought Ethereum anymore post September 2025. So that was the first thing. The second thing is that BitMine only has the intention to ever own a maximum of 5% of Ethereum supply. And so even the purchasers of BitMine themselves, they are coming down. And because of that negative outlook, since September, Ethereum is underperforming Bitcoin again. If there's no strong narrative around Ethereum, it tends to do bad. It only tends to do good if there's some massive development happening. Otherwise, it goes down. And so it's going down ever since. It has already sold off a lot. We made a lot of money with that crash. This cross here, oh, by the way, that was when we entered our short. That's when I announced in premium that we bet on falling prices of ETH. If we take that away, right, make the chart a bit cleaner, we can see the overall trend is bearish. Could we see a short-term relief rally of maybe 10%, potentially even 13% or so relative to BTC? Possible. I don't speculate on this. I always like to have the general market in my favor, right? If currently the trend is bearish, I try to short the tops. And the trend is bullish, I try to buy the dips. Most people only buy the dips, right? They think that the thing that they like will always go up. And so they just look for the buying opportunity when things are dropping. But I try to be more objective, right? I try to be the counterweight. If the current macro is negative, the trend is negative, I don't try to bet against the macro, because the problem is, let's say we were to buy Ethereum now and we would be betting on this potential bounce. If that bounce does not come, then time is running against us. Right? I want to have time on our side, even if we don't time the market perfectly. Right? Let's say we bet now on falling prices and we do see a short-term relief rally. Time is still on our side. We can just wait it out. We can just wait until we subsequently see the sell-off. So if the macro is on our side, we don't have to pick the tops and the bottoms perfectly. Things just play out over time in our favor. But if the macro is not on our side and we buy the dip and we hope for the counter rally and it doesn't come, instead we just go sideways. Maybe we bleed a bit further. At what point are we going to sell? That's the big question, right? When do we feel that we got beaten by the macro? That's the problem. Time is not on our side if we bet against the general macro trend. Now, I'm especially bearish on Ethereum. I'm more bearish on Ethereum than on most other cryptocurrencies, because Ethereum is not very cheap versus Bitcoin, right? It's going down. But Ethereum, relative to the others' market cap, also does not look that great. So when we look at ETH and the altcoins, there's a lot of trading between them, right? The decentralized exchanges have trading in liquidity pools of Ethereum on the one side and the altcoins on the other side. So really many altcoins are not priced in US dollars, they're actually priced in Ethereum, right? When Ethereum goes down, then automatically the altcoin that's bound to the Ethereum price in the liquidity pool also goes down by 10% without a single trade happening. And so we've got direct correlation between Ethereum and the altcoins. There's more correlation between ETH and alts than between Bitcoin and the alts. So the assets tend to move more in sync. And so looking at how the capital is moving between ETH and the altcoins makes a lot of sense. They tend to just move in a range. So how I measure the altcoins in this instance is by looking at the others market cap. So others is the market cap of all the altcoins that are not in the top 10. And when we look at this chart, this is a very long-term chart, right? It starts in 2017. And since 2018, we tended to be in a range. Sometimes the Ethereum market cap was 2.3 times the altcoin market cap. Sometimes it was slightly smaller than the altcoin market cap. So 90% of the altcoin market cap. And we trade every now and then. We've got relatively constant ranges. We've already seen the sell-off of Ethereum with the recent crash, but we aren't yet at historically low levels. And so I do not think that Ethereum will bottom out anytime soon. Ethereum can even underperform the altcoins that tend to be more risky by another 34%. And that's something that most people don't have on their radar, right? Most people think that if we are in a bear market, that the altcoins are just a levered bet. So let's say Bitcoin goes down by 10%, then maybe Ethereum might go down by 15%, maybe Solana might go down by 20%, and maybe the smaller altcoins might go down by 30 or 40%. That's the conventional thinking, but actually that's not true. What I think is happening is just capital rotation. From Ethereum to the altcoins, from altcoins to Ethereum, from Ethereum to the altcoins. That's what this squiggly line really means. The only reason why the altcoins in price long-term underperform is because of token inflation. But when we look at market caps, we've got a relatively constant range. And so I just trust this long-term trading range. I just think we are currently in negative momentum. And Ethereum has the potential to underperform the rest of the altcoin market by another 34%. If we take out the initial adoption phase and we just look at the exact price since we established that trading range, and we look at its average ratio, right? How did Ethereum relative to the others market cap trade? We might make the argument that Ethereum is already a bit cheap, that maybe we could buy Ethereum for a potential outperformance of 9% or so. So we are clearly trading momentum here. We are not trading valuation. But again, I think that those momentums, those moves are relatively constant. And so I rather think we are going down from here than going up from here. Again, just because based on momentum, not necessarily based on valuation. In terms of valuation, Ethereum might outperform slightly. But again, I'm not betting on this. I'm betting on the general trend. And the general trend, I think, is still rather bearish. And so this, I think, is very, very important, right? It's important to figure out where Ethereum is going because it does lead the altcoin market to a degree, at least in US dollars. And so when I'm not discussing many altcoins, it's because I'm also bearish on Ethereum. And Ethereum especially, not Bitcoin, but Ethereum especially drags down the altcoin market with it because many altcoins are directly coupled with Ethereum. And when Ethereum is bearish, why be bullish on altcoins? I'm more bearish on ETH compared to the altcoins, but I'm also not buying the altcoins because I do think that Ethereum is likely going to come down from here. That's fundamentally how I currently see the market. Let's have a look at a few more questions. Have the S&P 500 and crypto decoupled a few months ago? S&P went up, Bitcoin, crypto down. Yes, to a degree. It's always hard to say, right? So we can have a look at the following. So let's go to Bitcoin. Let's have the Bitcoin market cap at the top. Look at the entire history. And let's add the correlation coefficient of the NASDAQ 100. And let's set the duration of that correlation because 40 days is not enough. Let's take a year, right? So that's 2 times 186 days. Let's also make this line a bit more visible. So here is that correlation coefficient. And this is the breakdown that we potentially consider. Is there a breakdown? Potentially, right? So when the correlation coefficient is at 1, that means the two assets move in the same direction at the same time. When the correlation coefficient is at -1, that means they move in opposite directions at the same time. When it's at 0, it means there is no correlation at all. The two assets are independent from one another. This is now over the course of 1 year. What we can see is that over time, correlation tends to increase, right? It tends to go up. The bottoms are higher and higher, and we tend to creep more often at the 1 level. So I do think that long-term correlation is going up. In other words, the two assets move more and more in tandem with each other. Can we already say that the assets have completely decoupled? Not necessarily, right? Because we have seen similar kinds of movements to the downside as well. What this here implies, right? If this support stays the way it is, what this implies is that the two assets will move in the same direction going forward. So if we expect that Bitcoin continues to go down from here, as an implication of this chart, traditional finance should also rather sell off. But I don't want to make too many predictions from traditional finance, right? Traditional finance is very hard to trade. The competition is very high. But at least this metric here would suggest that the two assets will be more correlated going forward. If we suddenly see negative correlation again, right? If we don't see a positive coefficient here, but actually the two assets move in opposite directions over the course of an entire year, that would actually be very positive. I would actually like this a lot. And the reason why I would like this a lot is because this gives a good reason for traditional finance to diversify into crypto again. Because the traditional portfolio manager, right, that manages endowment funds funds that manages high net worth individuals, etc. They are looking at data like that. They are looking at correlation coefficients. They might be blindly following Markowitz levels, right? They might be looking at what was the correlation in the last year, what was the relative expected returns. They might build a portfolio based on Markowitz portfolio theory. And if you've got very low correlation, that means an asset becomes more attractive as a diversifier in a portfolio. That will reduce the overall portfolio risk. And so that's a good thing. If we see Bitcoin, so that's the ideal case. We see Bitcoin selling off more and more. We see Bitcoin going below the realized price. At the same time, traditional finance does not sell off. We see a negative correlation coefficient that would very likely trigger traditional finance capital managers get into Bitcoin again. Because it's then the nice diversifier. It then shows that we have seen a decoupling. And that's great. That's actually what we do want. We want to have asset classes that are not correlated to each other, but that do over the long term at least appreciate with monetary debasement. If we think that Bitcoin appreciates with at least a 6.8% per annum, and at the same time it has very little correlation to the rest of the market, to say the S&P 500 or to the Nasdaq 100, then that's great. Then we can buy both and the overall volatility of our portfolio goes down. It will be less squiggly. We will just appreciate with monetary debasement. We get rid of the inflation tax. We get our purchasing power appreciation potentially over time, at least in terms of consumer goods. And that's actually the ideal case. That's the best case scenario. Will that happen? I don't know. Can we already say it has decoupled? Probably not. We're not yet in negative territory. But if we are going down as we expect and traditional finance does not go down, which would be ideal, then Bitcoin becomes extremely attractive. Now, I've been talking about the realized price so often. We will be talking about this in this stream as well. So let me actually just get it here. This is the Bitcoin realized price. It's the average cost basis of the market. I talk about this in almost every video. And the best time to buy BTC historically has been when the average Bitcoin investor was in unrealized losses. Currently, we are at $54,725 for the realized price. Once we are below, it might make sense to do first purchases. We will not bottom out very likely at that price. We'll probably go below that. But if your time horizon is long enough, it makes sense to do first purchases. That's at least how I ride the market. And then just forget about it, right? If it even falls a bit further, if you go at 50K, at 45K, at 40K, we just buy more and more. That's my plan. So are we currently at the bottom already? I think there is no data that suggests this. This here is the monthly relative strength index of Bitcoin. The relative strength index measures how quickly we currently go up and down. It basically measures, are we currently selling off extremely quickly? Are we currently appreciating very quickly? And the idea is that if we shoot up too much or if we crash too quickly, that maybe we are outside of something that could be considered an equilibrium. And so we should then potentially buy when the RSI is low. We should potentially sell when the RSI is high. And so the monthly RSI is just a bit of a longer term measure of that. Now, why do I not say that we are particularly cheap here? We are obviously low on the level, but have a look at this. Over time, the lower RSIs tend to get lower even, right? We tend to have a negative trend. And so this suggests, again, that Bitcoin hasn't yet bottomed out. A very similar metric to what we've already seen with the drawdown from the all-time high. The metric that we looked at the very beginning of the video, also when we look at this metric here, the 1 year rolling return, right? It doesn't suggest that we are already at the bottom. When we came from a top before, we tended to sell off longer. And the relative strength index, the monthly relative strength index, is just another way to look at the same data. Let me actually adjust this a little bit. Here you see the annual changes. So yeah, I don't see a reason to already buy now for the longer term. Of course, if you want to have some exposure, if your exposure currently to Bitcoin is 0, you should always have some, but that's just fundamental portfolio theory, right? We always want to have some exposure to all asset classes at all times, but we want to have more exposure as an asset class becomes cheaper and cheaper. And we might have slightly above average exposure to Bitcoin right now, but we should definitely have above average exposure once we are below the realized price and then buy more and more. And again, currently I rather bet on falling prices since we are below the realized price. Let's have a look at a few more questions. And again, thank you so much for all the questions. Thank you, of course, also for all the support, for giving this stream a like and helping it spread in the algorithm. Was hältst du vom S&P 500 ETF accumulating 15 Jahre und länger? What do you think about accumulating the S&P 500 for 15 years or longer, since returns are compounding? So just translating this here. Yeah, in general, right, it makes sense to own anything that counters monetary debasement. If you're not invested in anything, you're losing 6.8% per annum relative to everything else. So if your time horizon is 15 years, you want to be in something, and the S&P 500 is just one of many ways to get exposure. You want to have more than just the S&P 500 though, right? You want to have a diversified portfolio. The whole system is corrupt. Every financial system has winners and losers, and corruption is just a way of expressing whether or not the rules are fair. And if you consider the rules fair or not depends on where you are in the system and if you have been able to get an alpha in the system. So yes, markets are corrupt. It is unfair. Life is unfair. Just figure ways to beat the market and be more informed than the rest. That's my comment here. I'm not a fan of corruption. I'm not a fan of playing unfair, obviously, but it's the reality, right? We have to figure ways to beat others, and that's by being more informed than others. And that's actually a more fundamental thing that I actually want to talk about. In the end, right, there is the academics that say that markets are efficient, right? That we have all the info already priced in and that all public information is priced in and that there is no gains to be made in a market unless you're an insider. But really, what the academics are saying here when markets are efficient is, what they're leaving out rather is that it's people that make the markets efficient. So some people obviously made money to make the market efficient. So it's really a player versus player game in the end. It's really trying to figure out things that most people don't know. And so the key to outperformance is trying to ride the gray zone. It's trying to find information that's hard to get. It's not necessarily to find illegal information, right? We don't want to cross the barrier of becoming illegal and getting jailed for anything, getting any kind of punishment. But there is a huge gray zone where money is to be made, right? So let's say crypto, right? Let's take a crypto example. If I watch a YouTuber, like say a YouTuber that always promotes small altcoins, that pumps and dumps on the audience, right? A YouTuber that buys a small altcoin, a micro cap, buys a lot of the supply, then afterwards makes a video about that small altcoin. And after he made the video, the altcoin goes up because all the followers, all the subscribers, they bought into the altcoin. The altcoin goes up and the YouTuber seems to be like a prophet. He looks like Jesus, right? He talks about a thing and suddenly it goes up because all the subscribers bought in. And then he dumps on the audience because he bought the token earlier. He then afterwards sells, right? This is known as pump and dump. And this could also be known as, say, corrupt trading. And I've never done it and I never will do. But I still made money from that concept. And here is how. Many of those people that make those kind of videos, they will tell you, I am so convinced in this project, I put in $100,000 of my own money. But they are completely transparent about this. They say, last week I bought $100,000 of this coin. And the coin maybe has a market cap of only $1 million. Right? So he bought a lot of the supply. And he says this publicly. When that happens, right, what we can do now, what I can do now, what we did in the bull market, is we can have a look at the on-chain metrics. There's actually a tool for that in the premium membership, an on-chain tool, where we can have a look at what wallets bought that many tokens or that many US dollars worth of the token in that particular time frame. And so then we just have a look at what wallet bought $100,000 worth of a token of this microcap in the last week. And then we get maybe 1, 2, 3 results. Who knows? Maybe we only get one wallet, then we've got already the wallet. Maybe we get 2 or 3 wallets, then we have to narrow down what's actually the wallet of the influencer. But with analytics, we can find out the wallet of the influencer. And so what we then can do is we can set up alerts, right? We can set up alerts whenever this influencer is now buying again another token, another small token worth $100,000. Then there's a good chance that this influencer is going to make another video again about this in the future. And then the token will rally. And this is how we made money in premium during the bull market, right? When a lot of new people enter the space, they don't really know how it works. We can make money off that. Now, this is getting an information edge. In theory, right, all of the data is public. It's a public blockchain. And this YouTuber made the public announcement. I bought that token. And using the public announcement, we connected the dots and figured out the wallets. And we figured out what he's buying. And the buying was also public. It was on the blockchain. We used public data in order to have an information edge versus most people, because most people don't go those steps. Most people don't know how to do it, or they don't want to put in the effort to learn it, or they don't have the tools, or they don't want to build the tools, or they don't have the idea of doing this in the first place. And so that's where the alpha then is created, right? You can understand hopefully how this works. It's not just randomly buying based on lines. It's not just guessing the macro. It's actually having an information edge. It's trying to figure out what are market movers doing and when are they going to move the market. And so it's of that with any market, right? You want to have an information edge. You want to know why you should be the person that outperforms. And the money is always made in the gray zone, right? There's hedge funds that have bought satellite images of agricultural of farms that figured out, okay, how great is today's harvest versus, say, the harvest in the last years, to then anticipate where commodity prices might be going. It's just getting the information that is public or that can be gotten when the steps are taken to get an information edge. And so then markets become efficient by people. So markets are not as per default efficient, they become efficient. And so what is really corrupt? Is it corrupt to get this additional information, have the market edge? Is it corrupt to find this influencer wallet and then dump on the innocent audience that the influencer himself is already dumping on? I'm not sure, right? It's always about, if you have more return than the average market participant, right? If you make more than buying and holding, by default, you're taking the money from somebody else, right? Everything that's above the market return, everything that's above that return is taken from somebody else. So you're part of the few winners at the expense of most losers. And so it is a player versus player game. It is competition. It is winning money from somebody else. You're taking money from somebody else that might not be as smart, that might not put in as much effort. There's many reasons for why you are outperforming, but you are more skilled, you are more informed, you are making more money. And if that's not the case, then it's simply because you don't have the edge, right? And the edge is created through knowledge, through skills, through knowing people, through getting information that most people don't have. And ideally, you get that information not in the black area. You don't do traditional finance and try to find the next annual report that most people don't have and trade based on that. Ideally, you just get more information by putting in more effort than others. A long-winded answer to a question that I think needs addressing, because most people don't really understand how alpha is generated, how outperformance is really generated. Thanks for the question though, or thanks for the comment rather. Minus 50% coming next month in the traditional markets. It's hard to time it, but minus 50% is definitely possible given when we look at the long-term valuations. The Schiller price to earnings ratio, for example. Third live stream caught. Love them, thank you. Thank you for the comment. I enjoy doing those things as well. It gives me always some inspiration what to talk about as well. Getting some feedback as well. 100% humanoid robots will come this year. Made in China 2.0 is here. Maybe I have to get into this in a bit more detail, but the first info I got from this is that it's extremely hard to replicate the hand properly, that it doesn't wear out that quickly. And what I'm personally waiting for is that humanoid robots actually become productive in a certain capacity where it becomes economic. So I want to see, so for example, selling humanoid robots to a household is probably not profitable that quickly. It's probably quicker. The probability will probably be reached faster in, say, a factory setup, right? Having a humanoid robot doing things that specific purpose robots can't do, right? Moving things from A to B, doing things that humans normally would do in a factory. This is probably where humanoid robots could become productive first. And I've seen humanoid robots getting deployed in a factory in BMW in the US. But I haven't seen this getting rolled out more. I haven't seen this getting scaled more. So probably that was also not economic yet. And so I'm looking for a first indication. And if I see this, and if you have this, please comment this down below. But a first indication where a humanoid robot has been used and has been scaled to a degree where it was clear, okay, this is economic. Buying the humanoid robot actually gave more return. It was not just a display of giving out popcorn, but actually using that humanoid robot for this specific task was cheaper than using a person. And if that's true, then I will change my mind on the topic very quickly as well. But I haven't seen it yet. If you're down 83% on your alts, would you still sell them? Yes, I would still sell them. Right? It's a sunk cost fallacy. You don't want to hold a bad investment just because it's down. It's painful, but it's the ugly truth. Have you considered using some sort of more dynamic optimized trend for backtesting? I'm subscribing to one that seemed to outperform the 44-day simple moving average, but I have to look a bit closer. Yeah, if you've got more information on this, feel free to send this either in the chat or maybe, because I'm not sure if I can get through all the chats in the stream, maybe post it as a comment after the stream has been published as a video. Those comments I will see longer term. I think the chat messages themselves, they disappear. Do your dollar cost in at the lows? Yes, I do. Once we are below the realized price, I do buy some native Bitcoin that I never sell. Don't you think the next 2 years gold will outperform silver? Potentially. It's a similar kind of question whether or not Ethereum will outperform Bitcoin. In the end, measured in US dollars, it's probably not that important of a deal. The asset class itself is more important than the decision within the asset class. So the decision between Bitcoin and Ethereum is not as important as the decision between, say, gold and Bitcoin, right? So the asset class allocation is much more important than the selection within the asset class. Yeah, there is a chance that gold might outperform silver. Silver has run quite a bit, but there's so much talk now about gold, so much talk about silver. It's now a popular trade. probably a bad idea to get now into it. We bought it 1.5 years ago and sold it recently. And yeah, it's urgent because it's a live stream, of course, right? But yes, I do, maybe I do want to address this a little bit, right? So that's something I don't address normally in the regular videos, but now we've got some time, we're in the live stream. I do have kind of clickbait titles, clickbait thumbnails. The reason is if I don't, the number of viewers is significantly lower. It could cut by like 30, 40, 50%. And the question is always, do I want to reach as many people as possible with the message? I don't want to have clickbait content. I want to have content that is educational, that people get real value from, where people can really trend at least towards starting to beat the market. The vast majority of people lose, but if with my content you're able to slightly even at least outperform, that's already a win. And if I can get a lot of people that usually click on those clickbait things, that usually follow the people that shill the big altcoins, when I can get many of those people clicking onto content that's a bit more based, that's a bit more based in reality, basically, a bit more data driven, then I've won as well, right? I don't just want to address the people that already have a kind of rational academic approach to things and forget about everybody else. I want to get many people to come and learn as much as possible. And I achieve this, unfortunately, through clickbait as well. And when you look at the titles, say in premium, right, the people that have already been committed to this channel, that are already paying, the titles of the videos in premium are very descriptive of the content, right? It's like, it's super dry. It's like measuring the outperformance of the RSI indicator on Solana in the last 5 years, or measuring the correlation of last year's performance to the next year's performance, or correlation analysis of ABC. So if I were to title YouTube videos like this, my views would be close to 0. But if you already subscribe to premium, you know that the content is good. I can actually describe what's exactly in the video in the title, but in YouTube, I unfortunately can't. In YouTube, it's first about the reach. And once I get the reach, I can then try to still, in a somewhat entertaining manner, try to give the hard truth sometimes. Like, yes, it's okay to sell altcoins even when they're down 80%, which nobody else is going to tell you because it's a hard pill to swallow. And it's also potential thin ice that I'm getting on, right? As in, if the altcoin is down 80% and I tell you to sell and I don't know where things are going, I'm just basing my judgment on the data that I see and based on the probabilities that I estimate. And then the altcoin suddenly rally, because even if something has a chance of 20% to become true, it can still become true. So if it then suddenly rallies and I said I would sell, then it's very easy to get, pointed at and say like, you told me to sell, I could have had my money back because I sold, I lost, or I didn't get the gains that I should have. So that's a potential dilemma, right? That's a potential dilemma. So that's why I try to tell the entire story. I try to tell my reasoning, and I try to tell how I come to conclusions regarding certain things. And then ideally, you just take this into consideration and make your own judgment. You look at the fundamentals that you have analyzed, you look at the reasons why you should buy something, and then you should come to your own conclusion. You shouldn't just copy what I do, but you should rather take what I have to bring to the table as data and consider this in your own decision making. One popular argument that Bitcoin goes up forever due to 1 million fixed supply, but since we can buy sets or even smaller fractions, isn't the supply technically infinite? No, it's not. The supply is not infinite. We can split it up, but 21 million is a fixed supply so far. We're now currently at 20 million roughly. The last million will get issued very, very slowly. Bitcoin gets lost at a quicker rate than it gets mined. So actually the circulating supply is already shrinking. And so the only reason why it might underperform other risk-on assets over the next years is if the long-term holders that bought Bitcoin in the very early days sell at a quicker rate. But over, say, 100 years, it will definitely be higher if the monetary base continues to expand by its 6.8% per annum. So there's no question about this. Same way as, say, gold appreciates over the decades, right? Simply because the dollar devalues over time. But the appreciation comes in waves, right? There can be 10, 20 years of nothingness to then get all the gains within a few years. This is typically what happens. Assets get forgotten over time, and then they start to appreciate with the devaluation. They tend to reach some certain threshold. They appreciate faster than other things. Attention comes, momentum comes, rallies appreciate faster until we are at a reflection point. We can't grow any quicker. Then things turn around again. But that's why we get these kind of almost step functions in appreciation, why we don't see just constant growth of an asset over time. It's just a cycle of attention from asset class to asset class. Hi Gerhard, do you think Caspar has long-term potential, proof of work without permissions and pre-allocations? Yeah, the question is always about without pre-mines and pre-allocations. There's always a few people that mine more than others. The question is, when you hold Casper, did you ever set up the mining yourself? How distributed is the ownership really? Probably better than what happened with Ethereum, but still, technically it's superior to Bitcoin. But it needs to get the adoption, and Bitcoin is already a lot of mindshare. It has underperformed in the last years, and the question is, why did it underperform when there's nobody selling, right? When there's probably some people with heavy miners that sell their constant supply, their constant new supply. So we've already talked about this. This is the realized price, right? The average cost basis of the market. And what I like about this is that the vast majority of the time, this realized price is going up, right? So this is people taking profit. Now, this gives us an idea of where a bottom of a bear market could be. But what's also interesting about it is that sometimes it slightly goes down, right? During a bear market, some people do have to realize losses, right? So the vast majority of the time it goes up, but every now and then it goes slightly down. And if you look at this chart in a bit more detail, when you look at this, here we've got the realized price change, percent change. So when this is green, of course, people realize a lot of gains. When this is red, though, some people realize losses. And so this gives us another idea of why currently we might not yet be at the end of a bear market. During prior bear markets, we always had some people having to realize losses, or the realized price went down. So far, we do not see the market as a whole realizing losses. There's still profit taking going on. And if history is any indication, right, whenever we went into a bear market, we needed to have some kind of capitulation. We need to have some people that were willing to sell at a loss. We rather had the majority of people willing to sell at a loss. And while currently the profit realization is much less compared to what it used to be, and while this time the profit realization was also much more constant, we didn't see just one quick sell, but instead we saw constant profit taking. We don't yet have the loss realization. And that's another reason, right? Another on-chain reason why I think it's very unlikely that we've already bottomed out. I think that the bear market will continue. This year is the net unrealized profit and loss. So how much are people currently in net unrealized profit? And again, if the market in general is in negatives, if the average market participant sees red in their portfolio, and that's not just for Bitcoin, then we tended to bottom out in the past. Currently, we're not there. Currently, the average market participant is still 17% in profit. And so when people are in profit, there is the chance that that profit will get taken, at least partially. And that then more profit taking leads to declining prices. And that then once people have taken all of the profit off the table, people are realizing losses, people are actually giving up. That's the time to buy when there's real capitulation. But so far, it doesn't look like we are already at those capitulation levels. Does scarcity even matter if it's infinitely divisible? Yes, it does matter. Why should it not matter? I don't understand the argument. Just because, just imagine you've got a birthday pie and you can cut the pie into infinitely small pieces. It doesn't mean that you can feed everybody at the party. When you've got just a small pie and you make it into very small pieces and you've got 100 people at the party, people will not be satisfied with what they're getting. So no, divisibility is has no impact on scarcity. It just makes adoption potentially easier, right? You could potentially give everybody a piece of pie, but nobody will feel satiated. Very early in Malaysia. I can't believe I'm watching this time. Are you also in Malaysia? Then greetings. Yes, I like to wake up earlier because the vast majority of viewers is from the US and is from Europe, and the early times in Malaysia or the late times, very late times, like 10 p.m. afterwards, are the best for that. Thank you for the message. Ropesturt8132 Goathard. Maybe I should change the channel name to that. Once, when the bear market really bottoms out at around 40 something K, and we then buy, and then it turns around, then I will change it to Goathard. That's my promise here. You can quote me on this. You can clip this. Does the 44 and 125 day SMA work on all tokens or only on Bitcoin? It works on Bitcoin mainly. Moving averages in general work across crypto, but the optimal moving average is different for different crypto assets. You just need to be ahead of the curve on time, and then it will all snowball for you. Once you start buying one top, it will snowball negatively. That's true. That's true. Are you pivoting into Tony Robbins motivation speaker? No, but sometimes I get feedback. So I have these one-on-one talks every now and then, right? I think I publish one now every day. I like to record them, first of all, because they're timeless. So I can record several of them. If I go on vacation, I can just publish them. But secondly, also, I get a lot of positive feedback. And the reason why I make these videos is also because I personally feel like I've done a lot of choices right. This might not sound very humble, but I'm relatively happy with where I am now. And I used to be very unhappy 5 to 10 years ago. And I just like to share what worked for me. And it doesn't have to necessarily work for you. But for me, it worked to have an additional side hustle while having my corporate job, save all that money, invest all that money do my YouTube channel build up while having my job, then now working from home, and also share my private life. I'm also very happy with that. I just like to share this and hopefully give some helpful input for that, because I do think many people are still wondering what they should do. And even though I might not be the wise person knowing it all, I'm happy of where I ended up so far. I just like to share that, right? If I were to watch myself 5 or 10 years ago, I probably would have gotten quite a bit of value from that. And I probably wouldn't have to figure out so many things. And so that's why I do it. And I get the positive feedback for it as well. So that's why I make this kind of, even though, and that's actually the interesting part, even though they don't give a lot of subscribers. The main subscribers I just get from pure data-driven YouTube content, especially the altcoins. Many people search for altcoins, but not many YouTubers make videos on them. So I get a lot of subscribers on that. But since I don't buy altcoins, and since I always have to bash the altcoins, and since I bet on falling price of them, even though it makes subscribers and grows the channel, it's not always fun to do. But making those kind of one-on-one talks or making those kind of live streams, also live streams don't bring a lot of new subscribers. They're basically just talking to the current crowd. I still like to do them. And so it's always, it's a mix, right? You want to have a mix of things that are fun and things that move the needle monetarily, and that's what I'm doing. So that's where the motivational speaking is coming from. Yeah, let's get rich. If you must pick an altcoin, which one will you pick? I could pick an altcoin to bet on falling prices, but that's what I share with everybody that joins Premium, by the way. So if you're joining Premium, there's a, I haven't talked about this very often recently, but if you're joining Premium, I will give you, upon joining, once you are in the Telegram groups, I'll get a message once you join all the Telegram groups, and then I will send you a trade, a relative valuation trade, where you bet on one falling altcoin while betting on betting on Bitcoin, right? You bet on rising price of Bitcoin while betting on falling prices of the altcoin. The altcoin has high token inflation. It tends to underperform Bitcoin very consistently. And so I said this in the early videos. I didn't say this recently that much anymore, but I will send you that trade. And if you enter that trade and you do not make any money with that trade, so with the net position, right? Long Bitcoin, short the others. If you don't make any money with that particular trade after 1 month of holding it, then I will just refund the first month of Premium to you. So basically you have risk-free Premium. Of course, the trade is not completely risk-free. There is some risk to it, but I think the probability is very high that it makes money. And because I think the probability is high enough, I'm okay to give this money back guarantee. So that's how you can get your feet wet. You can make your first money with that approach, and how it goes away, how it's not anymore theory only, but actually becomes into practical money making. It's with that trade. So I will just, once you entered the Telegram group, I'll just send you that trade. Go long that thing, go short that thing. Do this, use it on that platform. So that's Hyperliquid, right? Open that trade on Hyperliquid. Keep it running for a month. And if after 1 month you don't have made any money with that net position, you just get the $125 back. So that's the offer. I might talk about this more often in the regular videos again, but yeah, there's no altcoin I would pick to buy, but there are altcoins that are very good to short. All right, I think we've answered most comments for now. I want to show a few more charts. So what we've got over here, that's the number of wallets that are currently in losses versus in profit. So this here is the profit chart. Currently, with the decline, of course, less wallets percentage-wise are currently in profit, only 70%. We can flip this, then we get this chart, right? The addresses that are currently in losses. What's interesting about this is that from one bear market to the next, it seems like the losses get a bit less severe. The US dollar drops, they are pretty much the same, but the percent of wallets that are in losses, they tend to decline. And so there is this potential line, right? Again, it's interesting how those trend lines tend to establish relatively well across completely different metrics. This again tells us that probably the bear market isn't yet over. We haven't yet reached that line. So more wallets have to get in profit in order for this to be a potential bear market bottom. Check this out. This is the Bitcoin hodl waves. How much of all of crypto is currently in wallets that have held Bitcoin for different durations in time? So that's for 10 years for the purple area here. It's for 7 to 10 years for the blue area, etc. Right? So we can see how actively is Bitcoin getting traded. If we just take the long-term Bitcoin, so we look at the Bitcoin that has moved for the last 3 years minimum, as in the holding period had to be at least for 3 years. If you look at that, we can see, first of all, long-term, there's more long-term investors, but we can also see how historically the long-term investors tended to only take profit during a bull run, right? So when Bitcoin hit a new all-time high, when it went higher and higher in price, that's when people took profit. And then when we were at the end of a bear market, the selling stopped. And then when we established a new positive momentum, the buying by the long-term holders came back. So that's interesting, right? The selling tended to only happen at the peak of a bull market, when the bull market was accelerating further and further. This is now different. Have a look at this. We are already selling since Bitcoin hit 60K. The long-term holders take profit much, much earlier this time around. And it's not clear whether or not they've already stopped selling, right? It's not clear whether or not we've already bottomed out. And so that's probably one of the major reasons why altcoin rally didn't happen this time around. The appreciation of Bitcoin was simply not quick enough because the long-term holders already started selling at around 60K. And up until 60K, we actually did have a bit of an altcoin rally, right? We did have the meme coin trading with Pump.fun. We did have Solana outperform quite a bit. But since then, the Pump.fun ecosystem slowed down, meme coin trading slowed down, Solana did not outperform anymore, and Bitcoin's performance also slowed down massively. And so that's the fundamental issue. The long-term holders are selling now much more quickly than they ever did. And that's then the big question, whether or not Bitcoin will long-term outperform. Will the long-term holders stop selling? Will they start to become bullish on BTC again? And if we've got still this risk in the market, I think it only makes sense to buy when the price is clearly cheap. I think it's only clearly cheap once we are below the realized price. Here's the long-term holder supply over time. And that's the final chart that I want to leave you with. The number of Bitcoin that was held by the long-term holders in the past, it tended to grow very consistently in line with how Bitcoin supply expanded over time, right? There was Bitcoin mining. But it seems like there is a turnaround finally. It seems like it's not that clear anymore whether or not more and more Bitcoin will be held by the long-term holders. Maybe some long-term holders are now taking profit for good, and maybe they're getting out of the system altogether. That's the big question. Will we have a new all-time high in the long-term holder supply holding? Or have we now turned around? Is 2024 the final breakpoint? Because we've already seen how Bitcoin is having a very hard time outperforming the Nasdaq 100 over the last 5 years and outperforming gold over the last 5 years. So something might have fundamentally changed. We'll only know in the very long term whether or not Bitcoin can still long-term outperform. But I simply just mitigate risk. I'm currently betting on falling prices since momentum is negative. There is the copy trading vault where I can simply just copy trade whatever I do. And unless we're really at dirt cheap prices, I'm just staying on the sidelines, right? I don't necessarily have to buy dips in the hope for a recovery. There's money to be made in both directions. We can make money when things are crashing. We can make money when things are appreciating. We don't necessarily have to have a bullish bias on a particular asset class. We should be exposed net delta positive to all asset classes, but on a particular asset class, especially one that we know very well, it's okay to bet on falling prices while being long the other asset classes. Thanks again for watching. Very much appreciated that you've tuned in. Looking very much forward to seeing you in the next live stream. There will be a summary of this live stream again. So I will cut out a few empty spaces. I cut out a few things to make this a bit quicker, a bit easier to digest. There will also be a recording directly here from the local computer. So the video quality will be also a bit better with the video that will be published roughly 12 hours from now. And then there will also be a few clips published, probably 4 to 5 clips. There will be 10-15 minutes in length where there's a few summaries of things that have been discussed today. Feel free to watch those as well. Thanks again for everything. Looking forward to your like. In case you haven't liked yet this stream and you got some value out of this, very much appreciate it as well. And if you haven't yet subscribed, of course, feel free to subscribe as well. There's also the premium membership where you can copy trade whatever I do. I've talked about this often enough. Thanks again. See you next time. Cheers.